Hey guys, welcome to Investify, where we help you grow your wealth through smart investments. Today, we will uncover the extraordinary secret that will fast track your way to early retirement. We're about to delve into a concept that may seem too good to be true, a hidden gem buried beneath the complexities of finance. Brace yourself for the mind-blowing revelation that a single seemingly simple action can virtually guarantee your financial success. I know, it sounds like a whimsical fairy tale, but trust me, this is the real deal. So grab a seat and prepare to have your financial world turned upside down as we unravel the astonishing truth behind this one magical key to retiring early. Get ready to unlock a future full of freedom, leisure, and endless joy. All thanks to one thing, which is the power of saving money. Saving money is the one thing that you need to do to virtually guarantee yourself financial success. It's time to embark on an exhilarating journey that will forever change your perspective on wealth building. Let's dive in and discover the extraordinary path to early retirement that lies right at your fingertips. Let's talk about the not-so-secret secret to achieving financial success: saving money. Yep, you heard that right. It's time to unleash the power of your piggy bank and master the art of savings rate. So, what exactly is a safe savings rate? It's the amount of money you should squirrel away each month or year to reach your goals, considering the worst-case scenarios of investment returns and your desired time frame. Don't worry, we won't get too mathy here.
1 minus 1 equals.
Equals 35.
But it's good to have a general idea. Now let's have the couple Adam and Amy as our example. They are on a mission to save up a hefty down payment for their dream home in just 3 years. They want to stash away a cool $50,000, adjusted for inflation. With an annual income of $60,000, they go all in and invest everything in a basic total stock market index fund. Risky move, but hey, let's roll with it for now. If they had the incredible timing to jump into the market after the 2008 crisis, their investment returns would have been impressive. That means they wouldn't need to scrimp and save as much from their own pockets. Based on the data, assuming they started investing in 2009, they would have needed to put aside around $14,400 per year, or roughly 24% of their income, to reach their goal. So here's the deal. Saving money is like having your own financial superpower. It's not rocket science, but it does require some discipline. Now let's see how Adam and Amy fare on their savings adventure. Will they conquer the down payment challenge and unlock the doors to their dream home? Stay tuned to find out. Let's take a trip back in time with Adam and Amy's savings adventure. If they had invested in the same funds back in 2000, just before the dot-com bubble burst, they would have needed to save a bit more. Their safe savings rate would have been around 41% of their income per year to reach their goal in 3 years. But wait, let's go even further back to the Great Depression and the 1930s. That represents one of the worst-case scenarios for stock market investors. To ensure success even during those tough times, Adam and Amy would have had to save a whopping 53% of their income each year. Now, don't worry, their situation is an extreme example. Most of us won't need to save that much to achieve our goals, but it's essential to understand the concept of a safe savings rate. It's the amount you should have saved on historical worst-case scenarios and your desired time frame. Here's the secret: buying the dip. When markets crash, invest more, taking advantage of discounted prices. Adam and Amy have a clever trick up their sleeves. They take advantage of market downturns by investing extra money during those times. It's like finding a sale on stocks. By doing this, they actually reduce the amount they need to save. But that's not all. They combine the regular savings during normal market conditions with the extra investments during downturns. This strategy gives their retirement plans an incredible boost. They're on the fast track to early retirement. Remember, having a solid savings rate is key to financial success. So start cutting back on expenses, especially the big ones like housing and transportation. Focus on those areas first, and once you've gained momentum, tackle the smaller expenses. You'd be amazed at how much you can save. Now it's your turn. Share your own plan in the comments below, and let's embark on this journey towards financial freedom together. Remember these 5 key principles for simplifying your saving strategy to retire early. Number 1. Save a percentage of your income. Set a specific percentage of your income to save consistently. Begin with a manageable percentage that aligns with your current financial situation, and gradually increase it as your income grows. Automate your savings by setting up automatic transfers to a separate savings account to make it easier to stick to your savings goals. Number 2. Take advantage of market downturns. When the stock market experiences a downturn, view it as an opportunity rather than a setback. Consider investing additional funds during these periods when stock prices are lower. By purchasing stocks at discounted prices, you can potentially enjoy higher returns when the markets recover. Remember to research and diversify your investments to mitigate risk. 3. Combine regular savings with extra investments. Create a balanced approach to wealth accumulation by maintaining your regular savings routine during stable market conditions and seizing opportunities to invest more during market downturns. This strategy allows you to benefit from compounding returns while taking advantage of market fluctuations, ultimately accelerating your progress towards your financial goals. Number 4. Focus on reducing major expenses. Take a closer look at your major expenses, such as housing, transportation, and discretionary spending. Seek ways to optimize and reduce these costs without sacrificing your quality of life. Consider downsizing your living arrangements, exploring alternative transportation options, and finding creative ways to enjoy affordable entertainment and leisure activities. By targeting your largest expenses, you can free up more funds for savings and investing, significantly boosting your financial progress. Number 5. Keep educating yourself about personal finance. Continuously expanding your knowledge and understanding of personal finance is crucial for long-term financial success. Stay updated on financial trends, investment strategies, and money management techniques. Read books, follow reputable financial blogs, listen to podcasts, or attend seminars or webinars to enhance your financial literacy. By continuously educating yourself about personal finance, you equip yourself with the knowledge and tools to make informed decisions, adapt to shifting economic conditions, and uncover fresh opportunities to optimize your savings and investments. Knowledge is power when it comes to securing your financial future. Stay consistent and disciplined on your financial journey. Adjust your plans as needed, save like a boss, and celebrate every milestone. Keep learning, make informed decisions, and simplify your saving strategies. Financial success and early retirement await too. So go forth confidently and embrace a bright future. Good luck in your hilarious and prosperous money adventure. That's it for today. Thank you for watching. Don't forget to like this video, subscribe to our channel, and ring that notification bell for more updates here on Investify.